In this tutorial, we're going to just jump right in now and start recording some transactions. Um, when I first learned accounting, we used a technique which was referred to as a T account. And essentially a T account is simply a way of representing an account so that we can visually see the debits and credits accumulating in a very visual and logical manner. So the first transaction I'm going to record is when you first started your company, you and your partner each put up $500. So how I would represent that is, first of all, we'll look at the bank account or the cash account, and that's an asset. And here's our T account for the cash account, and then we'll the source of the money is an equity account called contributed capital. For your partnership, that account could also be called a partnership interest. That's another way of naming the account. Okay, so the source of the money came out of your pocket and your partner's pocket, and so the source of the money is our credit. And in a T account, we record all credit transactions in the account on the right-hand side of the T, and all debits on the left, and that holds true for all. So you put up $500. And where did that $500 wind up? It wound up in the cash account, so on the left. And your partner put up $500. And where did that money wind up? It wound up on the debit side of an asset. And so that transaction records the contributed money, the seed money. We'll call it the seed money. So that's our first transaction we're going to record. The second transaction we're going to record is that you then went to the bank and borrowed $1,000. So once again, we show the asset because where the money wound up was in the bank or the cash account. And where did the money come from? Well, this time it came from debt owed to the bank. So we'll call that a liability. We'll just short form it, and bank loan. And I like to prefix when I'm laying out T accounts. I like to prefix the category of the account just to remind myself where the money, where the value wound up, and where it came from. So the $1,000 came from the bank, and there it's recorded there, and it wound up in the asset cash account. Okay, so if we wanted to take a snapshot of our books at this point, we would see that we have in cash, we have $1,000, and that's in our asset cash. And our liability right now is a bank loan, and that's equal to, right now, no, I'm sorry, in cash we have $1,000 here and $1,000 here, so we have $2,000. And our liabilities, we have a bank loan, and that's of $1,000. And in our equity account, we have the money you put up, so we have $1,000. So our assets equal our liabilities, and our equity, 2,000 equals 1,000 plus 1,000. So that would be a snapshot of where we are at this point. Let's record a couple more transactions. Let's say now you buy your first set of turntables for $1,200. Okay, so where did the money come from? Well, it came from the asset, cash, and it cost you $1,200, so it's a $1,200 credit to the cash account. And where did the where did the value wind up? Well, it wound up in as an asset in equipment, in an equipment account. So this transaction shows that you've lowered your cash by $1,200 in order to buy another asset, which is equipment. And let's look at another transaction. This time we're going to buy the liquor for the first party you're going to throw. So again, our cash account's involved. And this time we have another asset account involved and it would be called liquor inventory. Because we're going to keep the liquor in your basement until you throw the party. So until you have your party, it's actually an inventory. So the source of the money, and let's say the liquor cost you $500. So the source is from cash, so that's a credit. And the destination of the value was into the liquor inventory account, so that's a debit to the asset account. Okay. So that records those two transactions. And I want to record one more because this one's a little trickier. The next transaction is you've had your party, and you were able to sell $2,000 worth of tickets. However, you've also had to collect on those ticket sales provincial sales tax and GST, the federal sales tax. So how would you record that? Well, for sure we know that the cash account's involved because we've got $2,000 in the cash account from ticket sales. So the asset account cash. And in this case, I'm going to record the destination first. So we wound up with $2,000 in cash. But where did it come from? Well, first of all, we'll have ticket sales. We'll just call it ticket sales, and we'll figure out what category that belongs to in a minute. But we also collected provincial sales tax and GST. So we have two more T accounts involved. Because of the GST is 5% of ticket sales and the PST is 7% of ticket sales, then just doing a little math, and I won't show you how to do that right now. If you need to know how to do it, just let me know. But the total ticket sales were $2,000, but part of that represents taxes that we owe back to the government. So when you do the math, you find out that $1,785.75 represents ticket sales, and the amount of GST that we own is $89.25, and the amount of PST that we owe is $125. Now, if you add those three numbers up, you'll get the 2,000. So our three credit transactions, the source of our money, came from these three areas. If we owe the government the PST, then clearly that's a debt. So the PST is a liability, and we could call it PST that we are payable. And we also owe the federal government the GST, so that's also a liability account. But the ticket sales, we don't owe anybody that money. That was, again, a result of your entrepreneurship and your hard work. And so we know that the ticket sales must be classified as an equity because it's not a liability. So this particular transaction shows an asset of $2,000, and that equals some liabilities to the government of $125 plus $89.25, and the equity of our sales, $1,785.75. So last lesson we learned that expenses were classified as equity accounts, and now we learned that sales of your product or service are also equity accounts. We saw last lesson that the expenses were typically debits to equity, and the sales are typically credits. And we'll come back to that in the next lesson.